In a matter of days, more than $14 billion in market value vanished into thin air, obliterating the life savings of countless retirees. It was December 2017, and the facade of a supposedly invincible global empire was crumbling in real time. The sudden implosion of Steinhoff International sent shockwaves through the financial world, exposing a labyrinth of deception that would soon be dubbed the Enron of South Africa. For decades, this conglomerate had cultivated an image of relentless, unstoppable growth. Originating as a modest furniture manufacturer, the company morphed into a titan of the retail industry, snapping up well-known brands across Europe, Australasia, and the Americas. Investors clamored for a piece of the action, seduced by consistently surging revenue reports and the aggressive, charismatic leadership of its celebrated chief executive, Marcus Giusti. Giusti was the architect of this aggressive expansion, driven by an insatiable appetite for corporate conquest. He surrounded himself with a tight-knit circle of loyalists, fostering a corporate culture where dissenting voices were swiftly silenced. Under his command, the mandate was clear: acquire, expand, and project absolute financial invulnerability, regardless of the underlying economic reality or the mounting costs of such rapid global integration. The secret to this miraculous growth lay hidden in the shadows of complex financial engineering. To fund its relentless acquisition spree without alarming investors with massive liabilities, the company heavily utilized off-balance sheet entities. These are separate legal structures created by a parent company to isolate financial risk, effectively keeping debt and toxic assets off the main corporate ledger. While legally permissible under strict conditions, they are ripe for abuse. In this case, the abuse was systemic and staggering in its scale. Executives weaponized these external structures to fabricate revenue and conceal crippling losses. By executing sham transactions between the parent company and these supposedly independent subsidiaries, they engineered an illusion of massive profitability. Money would flow out as loans or investments, only to be recycled back into the corporate treasury as operational revenue. This circular movement of capital masked a deteriorating core business. The retail giant was bleeding cash, yet its public financial statements painted a masterpiece of fiscal health. Armed with this artificially inflated stock price, the conglomerate continued its aggressive global shopping spree, acquiring massive chains like Mattress Firm in the United States and Poundland in the United Kingdom, paying exorbitant premiums. The audacity of the scheme was matched only by the catastrophic failure of corporate oversight. The board of directors, populated by respected business luminaries, remained largely passive, captivated by the soaring share price and the chief executive's formidable aura. Critical questions regarding the dizzying complexity of the European tax structures and the opaque nature of the offshore subsidiaries were either ignored or easily deflected. To maintain the facade, the inner circle engaged in relentless creative accounting, a deceptive practice where financial professionals exploit loopholes in regulations to falsely portray a company's financial health. They backdated documents, forged signatures, and created fictitious income streams to meet aggressive profit targets. The sheer volume of these fabricated entries required a meticulously coordinated effort among a select group of trusted insiders. The meticulously constructed house of cards finally began to tremble in late 2017. As the annual audit approached, the external auditors at Deloitte refused to sign off on the financial statements. They had uncovered glaring irregularities regarding the validity and recoverability of certain assets tied to the European operations. The auditors demanded an independent investigation into the convoluted web of offshore transactions. The refusal to certify the books triggered a catastrophic chain reaction. On December 5, 2017, the company released a terse statement announcing an ongoing investigation into accounting irregularities and the immediate resignation of Marcus Juste. The market reaction was swift and merciless. Within 48 hours, the stock price plummeted by over 80%, wiping out billions of dollars in shareholder equity. The resulting devastation extended far beyond the boardrooms of institutional investors. In South Africa, the economic fallout was a national tragedy. The government employees' pension fund, which managed the retirement savings of millions of public servants, had heavily invested in the retail giant. The sudden evaporation of that wealth threatened the financial security of teachers, nurses, and police officers who had trusted the system. To untangle the mess, a massive forensic investigation was launched by PricewaterhouseCoopers. Their exhaustive review spanned millions of documents, emails, and financial records across multiple jurisdictions. The resulting report revealed a staggering level of deception. Investigators discovered that over a period of several years, executives had recorded over $7.4 billion in fictitious or irregular transactions, artificially inflating the equity of the entire group. This phantom wealth was generated through a dizzying array of shell companies scattered across European tax havens. These entities existed primarily on paper, serving as dumping grounds for the conglomerate's bad debts and as fraudulent sources of income. By manipulating the intercompany loan accounts, the perpetrators effectively created money out of thin air, deceiving both auditors and the broader financial market. The sheer longevity of the fraud exposed profound vulnerabilities in global financial regulation. For years, regulatory bodies across multiple continents failed to detect the massive discrepancies hiding in plain sight. The fragmented nature of international corporate law allowed the perpetrators to exploit jurisdictional blind spots, moving liabilities across borders faster than auditors or regulators could track the underlying flow of capital. The survival of such a massive conspiracy relied on a deeply entrenched culture of intimidation and compartmentalization. Employees who noticed discrepancies were discouraged from asking questions, while the true financial picture was fragmented among isolated teams. Only a handful of individuals at the very top possessed the complete blueprint of the deception, ensuring that the broader workforce remained oblivious to the impending disaster. In the wake of the collapse, the shattered conglomerate faced an existential crisis. A new management team was installed, tasked with the monumental challenge of restructuring billions in debt and fending off an avalanche of litigation from furious shareholders. The company was forced to liquidate prized assets, dismantling the global empire piece by piece just to keep the lights on and satisfy creditors. Meanwhile, the pursuit of justice proved to be agonizingly slow. Despite the overwhelming evidence of systemic accounting fraud, building airtight criminal cases against the architects of the scheme took years. Complex financial crimes require tracing convoluted money trails through uncooperative offshore jurisdictions, a process that tests the limits of prosecutorial resources. The public watched in frustration as the perpetrators seemingly evaded immediate consequence. For years, the former chief executive lived in relative seclusion, shielded by legal maneuvering and the glacial pace of the investigation. He consistently denied any deliberate wrongdoing, attributing the company's collapse to strategic errors and a misunderstanding of complex European tax laws. Yet the forensic evidence painted a starkly different reality, one of deliberate manipulation and calculated deception orchestrated from the highest office. The walls finally began to close in as international authorities coordinated their efforts. German prosecutors issued arrest warrants, and South African regulators levied unprecedented fines for insider trading and the publication of false financial statements. The net was tightening around the key figures who had engineered the catastrophic deception, signaling that the era of impunity was drawing to a bitter end. The saga reached a grim and abrupt climax just as criminal trials were set to begin. Faced with imminent arrest and the prospect of spending the rest of his life behind bars, the man who built and broke the retail empire took his own life. His death left a void in the pursuit of accountability, denying victims the closure of a public trial. The sudden absence of the primary architect left many crucial questions unanswered. The full extent of the collusion, the precise mechanics of the earliest fraudulent entries, and the potential involvement of secondary enablers remained shrouded in mystery. The investigation continued, but the ultimate mastermind had escaped the judgment of the very legal system he had mocked for over a decade. The legacy of this massive corporate failure continues to cast a long, dark shadow over the global financial landscape. The billions of dollars lost by pension funds and retail investors can never be fully recovered. Settlements and restructuring efforts have yielded only pennies on the dollar, leaving a permanent scar on the retirement portfolios of those who could least afford the devastating blow. The scandal also triggered a crisis of confidence within the auditing profession. The failure of major accounting firms to detect a multi-billion-dollar fabrication forced a global reckoning regarding the effectiveness of traditional audit methodologies. It highlighted the urgent need for enhanced professional skepticism, deeper forensic capabilities, and a fundamental reassessment of how auditors evaluate the risks associated with highly complex, multinational corporate structures. In response to the catastrophe, regulators implemented stricter oversight mechanisms and demanded greater transparency regarding off-balance sheet financing. The rules governing corporate disclosures were tightened, and the penalties for financial misrepresentation were severely escalated. Yet, financial experts warn that as long as executive compensation is tied to short-term stock performance, the temptation to engineer artificial growth will remain a potent threat to market stability. The spectacular rise and devastating fall of Steinhoff International stands as a monumental testament to the destructive power of unchecked ambition. It serves as a stark reminder that behind the gleaming facades of corporate empires, the numbers can be manipulated to tell any story the architects desire. When the pursuit of endless growth supersedes fundamental economic reality, the resulting collapse is always catastrophic. Ultimately, this was not merely a failure of accounting, but a profound failure of human integrity and systemic oversight. The billions in fabricated profits were a mirage, sustained by a toxic blend of arrogance, complicity, and regulatory blind spots. As the financial world moves forward, the echoes of this unprecedented deception remain a chilling warning about the true cost of corporate greed.